In this lecture, we're going to be talking about the audit of internal controls over financial reporting. Up to this point, we've been talking about the audit from the perspective of the audit of the financial statements. The financial statement audit is separate and distinct from the audit of internal controls over financial reporting. In the audit of the financial statement, the auditor examines transactions and account balances and expresses an opinion based upon this test work. The audit of internal controls over financial reporting is where the auditor is expressing an opinion, not of the financial statements, but of the internal controls over the financial reporting. The audit of internal controls over financial reporting is a mandated audit by Sarbanes-Oxley. So any organization that's publicly traded or fits the criteria that they must comply with Sarbanes-Oxley must have an audit of internal controls over financial reporting. This audit has specific requirements for management and has specific requirements for the auditor. Management requirements include the acceptance of responsibility for the effectiveness of the entity's internal controls over financial reporting. Just like the financial statement, where we explicitly state that management is responsible for the financial statement, we also state, and management complies with this by saying that they are responsible for the effectiveness of internal controls. Management must evaluate the effectiveness of the entity's internal controls using a suitable criteria. The suitable criteria is, generally speaking, the COSO framework of internal controls that was discussed in our last chapter. Management is responsible for supporting these internal controls with an evaluation with sufficient evidence, including documentation. So Section 3 of this is essentially requiring management to establish a separate department. It could be either with internal audit or their own internal controls department that's responsible for evaluating, documenting the internal controls over financial reporting. And then finally, management is responsible for writing a written assessment regarding the effectiveness of the entity's internal controls as of the most recent fiscal year. So what this is saying is that as part of the financial statement, management is writing a letter that becomes a part of the financial statement where they are documenting their responsibility, they are documenting that they supported this with evidence, and they are evaluating the internal control structure. The auditor, as part of their audit, must also complete specific tasks. Now you notice that the entity's independent auditor must audit and report on the effectiveness of internal controls. The auditor is required to conduct what we call an integrated audit of the entity's internal controls over financial reporting and its financial statement. So we want to make this distinction, is there is a distinction between the internal controls over financial reporting, where the auditor ultimately is going to express an opinion of these internal controls. But we're also doing the audit of the financial statements, where the auditor is expressing an opinion of the fair presentation of the financial statements. So the auditor is expressing two opinions, and this opinion letter is going to be integrated in a single letter, or there may in fact be separate letters related to internal controls and related to the financial statement. You notice that it is an integrated audit. As we've been talking about the basis of the audit, we've been talking about it from the perspective that management is responsible for the financial statements. We now know that management is also responsible for internal controls. The auditor goes through a process. The process includes understanding the entity, examining the internal control risks, and determining the risk of material misstatement. This then determines the nature, timing, and extent of these further audit procedures. And from the financial statement perspective, these further audit procedures are substantive testing, where the auditor is measuring monetary misstatement. But you notice, as part of the financial statement audit, is that we are examining the effectiveness of internal controls. The Section 404 audit testing that the auditor is doing is simply an expansion of the audit of the financial statements, where we are integrating an assessment of the internal controls to the extent whereby we are actually able to express an opinion of these internal controls, and then we're completing the financial statement and expressing an opinion of the fair presentation of the financial statement. We need to understand the official definition of internal controls over financial reporting. Internal controls include things that pertain to the maintenance of records that are accurate and fairly reflect transactions and disposition of assets. So you notice that we're looking at transactions. We're also looking at assets. Provide reasonable assurance that transactions are properly authorized and recorded in accordance with GAAP. Provide reasonable assurance regarding the prevention or timely detection of unauthorized acquisition, use, or disposition of the company's assets. So we're looking at transactions, we're looking at assets, we're looking at GAAP. We're also looking at, and you notice 3 is misappropriation of assets. So we're looking at fraud. A control deficiency exists when the design or operation of the control does not allow management or the employee in the normal course of affairs to prevent or detect misstatements on a timely basis. A significant deficiency is a control deficiency or combination of control deficiencies over financial reporting that is less severe than a material weakness. A material weakness, a deficiency or combination of deficiencies such that there is a reasonable possibility that a material misstatement of the annual or interim financial statements will not be prevented or detected on a timely basis. What we see here is that we have the matrix of magnitude and likelihood. Likelihood being remote, and all the way to the right where we have reasonably possible or probable. And then on the magnitude side, on the y-axis, we're looking at things that are not material or significant. And then we have not material but significant. And then finally we have material. So what we're saying here is that if the deficiency is not material or significant or not material but significant, we're reporting to the audit committee and to management, but we're not reporting externally. It's only when we have a material deficiency in our internal controls that this is going to be reported as part of our audit of the internal controls over financial reporting. What management must do, and frankly this is how we always complete an audit, is management must follow through with a top-down risk-based approach. Top-down risk-based approach is to identify financial reporting risks and controls, identify where locations are that are at risk, and then evaluate the evidence related to these internal controls. As we had explained, most entities use the framework developed by COSO. This framework identifies 3 objectives: reliable financial reporting, effectiveness and efficiency, and then finally compliance with laws and regulations. Some examples of entity level controls are controls within the control environment, a top-down assessment, consistent policies and procedures, entity-wide programs such as code of conduct and fraud prevention that apply to all locations and business units. So when you notice this first item here, one of the things that should come to mind is a strong human resource department is a key element of this top-down approach related to internal controls. Human resources is bringing in the correct people. They're making sure that the people match the jobs, but they're also creating this environment where we have a code of conduct, we are able to have fraud prevention, and we're able to have consistent application of these standards throughout the whole organization. As an auditor, and frankly as management, as we are assessing our internal control process, there's no question, but one of the first stops is going to be from this top-down approach is human resource department. If you notice the second item, controls over management override, this is a critical element related to the overall entity level controls. We may have very strong controls related to transactions and account balances within the general ledger, but the question becomes is what happens to the financial statement after it leaves the general ledger? We've uploaded the data into an Excel file where management is preparing the final adjustments to the financial statement. Any adjustments that are made on this top side should actually be reflected in the financial statement journal entries or in the general ledger journal entries. We want to be sure that management is not doing what we're calling top-sided entries, where they are making adjustments to the financial statement, but these adjustments are not reflected in the general ledger in appropriate journal entries that are documented. The other piece that we want to be aware of is that there should be very specific controls over management related to their ability to generate transactions. In an organization that I worked at, we had a very strong control system. The senior accountant would initiate manual journal entries. These would then be approved by either the controller or the director of finance. And the CFO, while he had the ability to view all data, he actually only had read-only access to the data. So he was not able to make any changes to the financial statements. It's critical that we understand what the control structure is when we're looking at manual journal entries and who has access to initiate transactions, who has access to approve journal entries, making sure that any manual journal entries are recorded and documented and signed off on. Management must develop sufficient documentation to support the assessment of the effectiveness of internal controls. This may take many forms, electronic files, policies, job descriptions, flowcharts. You notice here that there is a requirement for this documentation. So within the finance department, there needs to be a department, a sub-department within this finance area, internal controls department, or it could be a part of internal audit, where they're responsible for examining the internal control structure, documenting this internal control structure in such a way that when the auditors come, that they're actually able to see what this internal control group has been doing in regards to documenting the internal controls. And why are we doing this? We're doing this because this is a requirement. This is something that management must sign off on as part of the financial statements. You notice here that we're looking at test of controls and substantive testing. And you notice how the two areas sort of commingle. When we assess the risk of material misstatement, now the further audit testing could be substantive procedures, and again, when we do substantive procedures, we are doing these substantive procedures to measure monetary misstatement within the financial statements. However, if we're looking at this from an integrated audit perspective, is our risk of material misstatement will determine additional testing that we're wanting to do, and this additional testing is related to the test of internal controls, and the test of internal controls is specifically related to our audit of internal controls. So the integrated audit that you see that we talk about in the audit of internal controls over financial reporting essentially means that when we are conducting these further audit procedures, that these further audit procedures will be substantive if we are measuring monetary misstatement within the financial statements, or will be further audit tests of internal controls when we are using these tests to measure the effectiveness of internal controls within the financial reporting. When we're conducting the audit, what we're looking for is we're planning the audit, we're identifying internal controls from a risk-based perspective, we're testing the design and the effectiveness of the internal controls, we are evaluating our results, and then we are forming our opinion. One of the key elements related to the audit of internal controls is creating a level of efficiency within this audit. The way we do this is what we're attempting to do is we're attempting to identify significant accounts and significant controls. There's many controls within an organization. We are not responsible for testing all these controls. What we're attempting to do is to identify the significant accounts, and within these significant accounts is identify what controls are appropriate and how these controls should be designed. So we're looking for size, we're looking for susceptibility to misstatement, we're looking for the volume of activity, the nature of the account or the disclosure, and accounting reporting complexities associated with the account or disclosure. We're looking for the exposure to loss, the possibility of significant contingent liabilities arising from activities reflected in the account or disclosure, existence of related party transactions, or changes from the prior period account or disclosure characteristics. So when we're looking for these significant accounts, we're looking for these accounts where things could go wrong. These are just some examples that we want to consider when we're looking at these accounts. When we're looking at these accounts, we need to understand that there are, generally speaking, some very specific sources of misstatements that we need to understand. So we need to understand the flow of transactions related to the relevant assertions. What are these assertions? Well, these assertions are the implied or explicit statements by management regarding the numbers that are part of the financial statement. We want to identify the points within the entity's process at which a misstatement could arise, and identify the controls that management has implemented to address these potential misstatements. One of the things that becomes very important as we are conducting this audit is we need to gain an understanding of the process. We gain an understanding of the process by inquiry, by observation, by doing very specific tests of controls, and we are documenting this. We're documenting this through a flow chart, which is generally speaking the most appropriate way to document the process. Once we've documented the process, it's critical that we gain the assistance of other auditors that are experienced in this organization and other similar types of audits, and basically brainstorm in terms of identifying what possibly could go wrong in this process. Once we've identified what could go wrong, we're then going to go to management and understand what internal controls there are in place to address these potential misstatements. This is where the critical thinking of an auditor is coming in. We document, and then we assess what we've documented from the perspective of understanding what could go wrong. Understanding what could go wrong is clearly going to go beyond just what we ourselves might be able to think of. This is why we want to bring in other people that have the experience, that have the knowledge, so that we can understand the context of these specific issues. With this information, we're going to select specific controls to test. Factors commonly considered when identifying controls to test includes these points at which errors or fraud could occur, the nature of the controls implemented by management, the significance of each control in achieving the objectives of the organization, and the risks that the controls might not be operating effectively. One of the things that we need to understand is that when we're doing the audit of the internal controls over financial reporting, is we are looking for what could go wrong. If we identify what could go wrong and it's significant, then this is going to be a part of our audit report. This is distinct from the audit of the financial statements. Although we're very interested in understanding what could go wrong as part of our assessment, the audit of the financial statements, we are expressing an opinion of the fair presentation of the financial statements. So we're looking for, in the internal controls, what could go wrong. When we're looking at the financial statements, we're looking for what really did go wrong, which becomes interesting in the sense that we may have a significant deficiency within the internal controls, but in fact, the financial statements may be not materially misstated. Because something could go wrong doesn't mean that it actually did go wrong. The types of reports related to the audit of internal controls include an unqualified opinion. The unqualified opinion signifies that the entity's internal control is designed and operated effectively. There are no material weaknesses. A serious, more than minor, scope limitation requires the auditor to disclaim an opinion, and an adverse opinion is required if a material weakness is identified. So what we're saying here is that there is an unqualified opinion. As long as there are no material weaknesses, we are able to issue an unqualified opinion. An adverse opinion is when we see a material weakness of internal controls, and a disclaimer of opinion is where we're unable to determine the internal control structure. Maybe the documentation was not in place, or there may be other issues. But in any event, there are 3 opinions that we're going to express related to the audit of internal controls over financial reporting. So what we see here, just the same thing, is if there's a controlled deficiency or a significant deficiency, we have an unqualified opinion. If there is a material weakness, we have a qualified opinion. If it's minor, unqualified. If it's more than minor, in terms of the scope, is we are going to disclaim the opinion or withdraw. Usually what this means is that management is not documenting the internal controls. Okay, so we've had a very brief discussion related to the audit of internal controls over financial reporting, and I thank you very much for your time.